Hello everyone and welcome to my next NAP. NAP stands for Nonprofit Auditor Points and I'm Irina Ryshkova, your nonprofit auditor. I designed these NAPs to explain to nonprofit community regarding GAAP and some accounting standards. Hopefully you will find them useful. And I continue the series regarding revenue recognition for nonprofits. We did talk in previous NAPs that non-profit revenue recognition is quite complex and can be very confusing because we use two completely different standards. 606, which we use for revenue recognition for exchange transactions, when the donor receives, not the donor, when the supporter receives the same value in exchange for services from nonprofits. It's exchange transactions. And the second standard, it's 958 for revenue recognition for contributions. And we use term contributions for gifts, grants, bequests, donations, pledges, promises. That's all under one umbrella of contributions. And we recognize it when contribution is unconditional promise to give. We also explained what means unconditional and what promise makes what makes promise conditional, that needs to have barrier and right of return the funds. We also talked about what promise means, that promise should and intent are not equal, and if there is a barrier and right of return the funds that create condition, we do not recognize revenue until condition is substantially met. Then we talked about multi-year grants, and the grants needs to be, even if the multi-year needs to be recognized again for the full amount as soon as they unconditionally promised. Then we discussed that even unconditional promise grants can be recorded differently, even though it does not affect revenue recognition, but it will affect classification. It can be revenue with donor restrictions or without donor restrictions. Then we talked that with donor restrictions come in two flavors: time restricted and purpose restricted. And we provided examples what time restrictions revenue would be and purpose restrictions would be. Now, today we're going to talk about what happens next after we identify that the unconditional promise is restricted by donor, either time or purpose. So what happens when those restrictions are satisfied? Because in this part, where many nonprofits get confused and sometimes make accounting mistake. So let's just remind ourselves, if a condition is unconditional but restricted, we do recognize it right away as revenue for full amount immediately. However, it is a classification that affects and we record with donor restrictions. That means that we increase with donor restriction column. Now, when nonprofit uses funds for specific purpose or overtime and restrictions expires, restrictions considered satisfied. And at that moment, funds are released from restrictions. But what does it really mean? It means that the amount moves from the column with donor restrictions to without donor restrictions. The key here is to remember, release does not affect revenue. We do not touch revenue any longer. Revenue was recorded in year one previously. Now, satisfaction, it means simply reclassification. It's not about new revenue. There is no new revenue. We're simply reclassifying. We're moving balance from with donor restrictions to without donor restrictions on the balance sheet which is a statement of financial position, but we do not affect revenue at all. Let me give you an example. Suppose in 2025, your nonprofit received $100,000 grant restricted for after-school tutoring program, and there is no condition, but it is restricted by purpose because we know it's for tutoring program. In 2025, we do record $100,000 in revenue and classified it as with donor restrictions. So it was $100,000 in revenue restricted. In 2026, your nonprofit spends $100,000 for this tutoring program. At that moment, the restriction is satisfied. So we need to record another entry, but it will be only reclassification entry, meaning it will be within balance sheet only, does not affect your profit and loss or statement of activity, does not affect your revenue. All you do, you just record the reclassification on a balance sheet in a net asset section. We decrease in net assets with the donor restrictions, decreasing because we spend them 100, and we increase in net assets without donor restrictions. So it's a simply reclassification entry on a balance sheet. So it's done through adjusting journal entries on your financial statements. Very important to remember, that does not affect any revenue amounts. Revenue was recognized in 2025 and that's it. No more revenue should be recognized in future years. Let's talk about presentation. On a statement of activities, you typically will see contribution revenue with donor restrictions, then separate line, net assets released from restrictions. So that release line will increase the without donor restrictions column and decrease with donor restrictions column. From the board of directors perspective, you can sometimes, this presentation might seem confusing. They might don't understand where this money come from, because money was received earlier. The release reflects only the fact that organization used the funds that were restricted for specific purpose. It's not revenue, right? Now let's see the same example for time restricted. Suppose the donor gave $200,000 in December 2025, and the funds were for use in 2026. So at the end of 2025, amount was time restricted. So the full $200,000 needs to be recorded as revenue with donor restrictions by time. On January 1, 2026, when the time restrictions expires and funds are available for use, meaning restrictions is satisfied, again, you will record release from restrictions at that time. And again, it will be only as a balance sheet reclassification transactions, even if the funds were not spent yet, because that's time restriction. Donor, when they gave money, they did not specify that you need to spend it. They said in 2026. So time is lifted and you record release. So again, you will record reclassification and you will decrease net assets with donor restrictions time, and you increase net assets without donor restrictions. Now, here's something very important to remember, and that in my practice we see it quite often. Internal budgets and intents do not create restrictions. Let's just say board decided to set aside $300,000 for new capital project. That's a board designation. It does not come from donor. it remains in net assets without donor restrictions. When you later spend that money, there is no release needed. You don't record any reclassification. Why? Because there was never donor imposed restriction. Remember, this name restriction come only from donors. The distinction is very critical for proper reporting. Why? Because even if the board designates some funds for any purpose, it's in the power of the board to change that designation at any time. So for accounting purposes, it does not really constitute a true restriction. Versus if restrictions comes from the donor, nobody except the donor can change that restriction. So now let's talk why this really matter beyond just simple accounting. If releases are not recorded properly, financial statements will be misleading. And you might actually see that restricted net assets are building up year after year, and you don't understand why if they do not record releases, or without showing that funds were actually used for the intended purpose. You also do not satisfy the client, the donor wish how the funds needs to be spent. Because donor that provides restricted revenue also might request the information where and how funds were spent. Therefore, if you want to have a proper financial statements to communicate with the donor, you need to show that the funds were released properly. So we want to make sure that we see when expenses were incurred for restricted program, and funders would want to see that correspondence release from restricted net assets. For the overall board and leadership standpoint, it's also important for transparency. The release line showed to donors that the organization is honoring donor intent and in compliance and follow the donor restrictions and releasing funds properly. So let's summarize this episode. What are the main points? Restrictions do not delay revenue recognition, but when restrictions are satisfied, you need to record proper release, and that release will not be on a statement of activity, it will be on a statement of financial position, and it's a simple reclassification between net assets with donor restrictions and net assets without donor restrictions. Only donor imposed restrictions create releases, because donor, if it's restrictions by board, they do not create releases because initially they're not even restricted funds. In the next episode, we're going to move into in-kind donations. They also donations, they also contributions, and they also needs to be followed the standard 958 contribution revenue recognition, and we will discuss it next time. Thank you so much. Thank you for being with me here today, and looking forward to see you in the next episode. Have a wonderful day.